Good afternoon and welcome to the Future of Finance. Today we will discuss why is foreign exchange so far behind in technology and data. I shall now pass you over to Dominic Hobson and the panel. Thank you.
Hello everybody and welcome to our webinar. I'm Dominic Hobson, co-founder of Future of Finance, and I'm delighted to moderate our discussion this afternoon. Our topic is why is foreign exchange so far behind in technology and data? The more I think about it, the more I think it's the wrong question to ask. Given the level of engagement by FX traders in the cryptocurrency markets, one answer to the question is certainly that the FX industry is not behind on anything to do with technology and data. In fact, FX may even be ahead. And today we're certainly going to touch on the impact of cryptocurrency trading on the FX markets. We're going to talk about central bank digital currencies and peer-to-peer trading. We're going to look at how the buy side needs to change the way it approaches the FX markets. We're going to look at the plethora of benchmarks. And we're going to look at the one area where FX does need to invest in technology, and that is post-trade. That is in desperate need of modernization. To help us pick through those topics, I'm joined by four experts in FX. Claude Goulet is formerly head of institutional FX and wealth sales at HSBC. He's now CEO at Siege FX Limited, the fully automated and market neutral foreign exchange peer-to-peer platform, which nets trades at the independent and regulated New Change FX mid-rate benchmark. Alan Guild is a former global head of FX and commodities execution services at HSBC and COO of FX options trading at Goldman Sachs, now using his experience to help clients of Hilltop Walk Consulting adapt to technological and regulatory change. Mathieu Herbeau is a former global head of FX at both BNP Paribas Securities Services and RBC Investor and Treasury Services, now acting as an independent FX consultant. Jay Moore is a former head of currency management at both State Street and Brown Brothers Harriman, who in 2019 founded FX Hedge Pool, a buy-side to buy-side trading platform that aims to reduce transaction costs for asset managers hedging currency risks. He is the CEO as well as the founder of FX Hedge Pool. In addition to our panelists, we do of course also have you, our audience. We want your questions, we want your comments, so do please send them and keep sending them throughout this webinar using the Q&A functionality at the bottom of the screen. We won't be saving them up to the end. We'll answer them as we go along. So you'll be, if you want to be, an integral part of this discussion right from the off. And I think I speak for all five of us when I say we're going to be very disappointed if we don't get lots of interesting questions. I'm going to kick our discussion off, as we've got lots to talk about, with cryptocurrencies. And I say that because one of the striking aspects of the cryptocurrency boom or bubble or whatever it is how many FX traders, both current and ex-FX traders, seem to be involved in it. Now, of course, they must to some extent be following the needs of the clients, but they seem also to have taken to trading Bitcoin and Ether as if it's just another currency or currency pair. But of course, it isn't, is it? Alan, perhaps I could come to you first to give us some thoughts on this question. Cryptocurrencies, if they're not currencies, what are they? Are they commodities? And why do FX traders seem to find it such natural waters for them to swim in?
So look, I'm interested obviously in the views of the other panelists and our audience as well, Dominic, as you were saying. I'm gonna start with I guess a view that a cryptocurrency is a commodity, in the sense that it's a product, it's an asset that you buy, sell, or invest in, as opposed to a currency, which is really something that you use for payment. In terms of, we look at cryptocurrencies today, yes, we all read the news articles that you can buy a pizza or you used to be able to buy an electric car with a Bitcoin. But really, if we look at why people are using them, they're using them for investment. In terms of why do I see people who I've worked with in FX looking to get involved in cryptocurrencies? I think it's an innovative market. And as I'm sure as we have the conversation today, we'll be talking about ways about some of the ideas, some of the technology could have a role in the FX market going forward. But probably more than anything, we're talking about traders who like a little bit of volatility, who like predicting markets and see an opportunity to test their hunch, test their gut, and do something that they enjoy doing.
Mm-hmm. Thanks, Alan. Mathieu, you've heard Alan say that this is not a currency; it's an investment. It's a commodity. It's also, I think, a hedging tool. Some of the people who are investing in it see it as a hedge against inflation. But you've also heard him say that FX traders like the volatility. what are your thoughts about the engagement of FX professionals in the cryptocurrency industry?
Well, first of all, I really share Alan's view of the nature of the cryptocurrency. I also view that more as a commodity than as a currency. To Alan's point, a currency, you could normally use it to settle something, but you can't actually settle much at the moment with cryptocurrencies. And it's difficult to talk about volatility when we've been looking at what's happened over the last few days. Losing 30% over a day, making 30% up again the day after. It's difficult to compare that to the FX market, which is much more mature, much more stable. I mean, you need guts really to get involved in the currency, in the crypto market these days. I personally would keep away from it, or buy something, sleep over it for 10 years, and wait to see what it's worth for your retirement. This is more the way I would approach it, and I would advise friends or people asking for advice. If they need to get involved, well, you may, but you should invest something that you can lose with a smile, basically. So I'm skeptical about cryptocurrencies. I've got more favorable views on stable coins and CBDCs, but cryptocurrencies like Bitcoin or Ether, I understand the underlying technology which is behind it. I think there are great promises in that market, from the underlying technology more than from the currencies themselves.
Well, I'd like to come back to CBDCs in a minute, but before we do, Claude, one of the things which cryptocurrency has given rise to is tokenization. Tokenization of all sorts of things, physical assets, but also securities. But one of the use cases which is starting to get traction now is that by tokenizing cash and collateral, every bank on the planet who at the moment is keeping very large sums of money and securities in these liquidity buffers in all the markets where they're active. By tokenizing that, they can start to economize on those. And in particular, in this case, economize on FX settlement and margining costs. Do you think that tokenization can help to achieve savings of that sort of magnitude? We're talking billions of dollars across the industry here.
Yeah, well, I don't know about those exact numbers, but yeah, I think definitely it's a very expensive part of what happens in foreign exchange. And you mentioned post-trade, but there's also a few things pre-trades that are equally expensive. The proof of asset, all these movements of collateral, which are not calculated in real time, it still requires movements of cash. There's settlement risk everywhere. It is a very, very expensive process to run. And let's not even talk about the messaging that goes along with all these things. So, of course, if you could start to move into something which is closer to a distributed technology, where you have a clearer golden source, where it's easier to actually measure in real time what your current exposure is and limit the amount of movements of cash that's required for you to transact or to pledge any of your tokenized assets for that purpose. Of course, you should quickly end up with something significantly cheaper, reduce your settlement times, and I think this is where the big savings are going to come. So a little bit like what my fellow panelists have said earlier, let's put aside the question of whether it's a currency or not a currency or whatever it is, but it's definitely something in that technology that can be reused even within current arrangements.
Cool. Dominic, yes. Yeah, I just want to pick up on something that Claude was just saying, because I think we can all agree that and it's going to be a theme as we talk for the next hour in terms of some of the data challenges in the FX market. And you talked about the problems with storing and transmission and sharing of data in terms of golden source. I'm just interested, Claude, how much you see that as about more modern technology and better solutions, and how much you see decentralization as being a key. Because I'll probably come at it from the other angle, that we need to improve and take lessons from things like tokenization and what we see at cryptocurrencies, but we don't necessarily need to do things without a central authority.
No, I totally agree. And the reason, and going back to Mathieu's point, why is nobody using it to pay for anything, is because by the time you finish paying, it's already worth something so different, and yet again in the currency. So why bother in the first place, right? So no, I think you're absolutely right. But I think if you take aside the parts of the crypto that scare everybody and the mining and all these things, but the actual ability that it gives you to be so much more efficient. How much would it cost you to process 10,000 tickets via a distributed ledger compared to doing the same thing via current arrangement. You know, if you had to not worry so much about the cost of your messaging, the cost about the moving that cash, the risk associated with moving that cash, the reconciliation of moving that cash, just for the sake of performing one transaction. And that is what I think the market needs to learn from, is this ability to be so much more efficient about how you process the transaction, as opposed to trying to figure out whether this is the right medium. We already have a medium called a currency, and I think it does what it's supposed to do. But do we have the best way to organize pre and post settlement operational mechanism? No, we certainly don't. And I think that's where the market is going to learn to be more efficient and cheaper.
Claude, could I ask you about one aspect of what we see happening in the tokenized market and in the decentralized finance market in particular? FX is an industry which is still, despite everything, very dominated by banks. And what banks do, you know, as banks or as FX prime brokers, is take credit and market risk onto their balance sheets. What we see happening in the DeFi markets is the development of a kind of collateralized non-bank credit taking place, in which people are lending their tokens, which can then be used to collateralize other trades. Do you think the FX market, and you talked a few minutes ago about efficiency, do you think the FX market has anything to learn from that process? Can we look forward to banks even being disintermediated in some way if the market is fully tokenized and on a blockchain?
Well, everything is possible, but I think banks perform that role and they perform it very well. I think the difference with FX and any other market is that there's no decoupling between liquidity and credit. And I think here we'll actually allow a lot more banks to perform what their key role should be, which is the provision of credit, and to be far more efficient about it. So yes, this may lead to some amount of disintermediation, but what I think it should lead to instead, especially in the first instance, is actually banks being far more performant in their credit provision. And as a matter of fact, all these technologies should enable banks who are not necessarily looking to compete as a market maker, but could certainly look to better monetize their balance sheet provision to their underlying clients. So I don't think this is, spelling the end of banks. I think quite the opposite. It's just probably helping a larger number of banks to perform their role far more efficiently than they were a few years ago.
Alan, I don't know if you have views on this, trading out of digital wallets and atomic settlements and so on might add to efficiency. Those are things we can learn. But do you think that anything that's happening in the DeFi market in particular threatens the franchise of banks in the FX market?
No, I'm gonna violently agree with Claude. I think it's about new technology making it easier for firms with balance sheet to deploy and track using that balance sheet. Markets rely on firms providing balance sheet in the forms of credit guarantees for transactions to happen, exactly as Claude was saying. And as technology progresses, firms can do that more efficiently. And as Claude was saying, more banks may be in a position to get involved, and other large corporate institutions with big balance sheets might want to use their balance sheet in that way. I'm perhaps less convinced that the sort of big corporates, and people talk about the tech firms obviously more than anyone else, are about to start using their balance sheet to provide credit in financial markets. It's a very regulated activity. It's not an easy thing to do. But absolutely, I think technology makes that easier, and it sort of expands potentially that credit capability going forward.
I'm going to bring up CBDCs in a minute, but Jay, I don't know whether that your cough a minute ago indicated that you had some views to express on banks and credit.
I fully agree. I mean, what everybody said here, it makes a lot of sense. I mean, I think we've been kind of in this sort of market structure for so long where liquidity and credit provision have been tied together by necessity, right? And so that has so much limitation on both sides, for the buy side and the sell side, in that, sell side firms in many cases are not great at pricing everything, right? And so they're constrained to use their balance sheet for what they're good at, and they're missing out and limited in what they're able to deploy their capital towards. Whereas, other banks are just the opposite. So, I think that there's this, change that we're seeing in the market through technology today, where that decoupling of liquidity and credit are creating opportunities for banks to participate in volumes and trades that they weren't really able to before.
and for other banks to be a little bit more optimal around how they're using their balance sheet rather than getting everything stuffed their way because they're good at pricing. So it's there's this ability to be able to be a market maker without necessarily having to provide credit, and separately being able to provide credit without having to be a market maker, I think really allows a lot more flexibility for the market as a whole.
Yeah, thanks for that. And I'll come back to you later on how good you think the buy side is at their side of that equation. How good are they at managing bank credit? But let's talk about central bank digital currencies. I think we've agreed that whatever's happening in crypto and in DeFi doesn't immediately threaten the banks. But what about central bank digital currencies? That could have a substantial impact on the spot market, could have a substantial impact on the swap market. It could disrupt the role of banks as credit intermediaries, simply because it makes cash collateral available much more readily. It may even, to the point that Claude was talking about liquidity buffers, could even make correspondent banks kind of unnecessary if these RTGS systems are linked up and start to interoperate with each other. So what's the likely impact? Mattia, I'm sure you've been thinking about this on behalf of your clients, who shall remain nameless, but what is the impact of CBDCs going to be on the way the FX market operates now, in your view?
Well, I think everything that you mentioned is quite meaningful, but it's probably something that to look forward to in a I would say not so immediate future. I think the immediate future focuses on enhancing cross-border payments, which don't necessarily have an FX impact, and there might be some exchanges of CBDCs between central banks using accounts that they will hold with one another. But the FX component is not that close to the CBDC projects that we've seen happening. You've run quite a few panels, Dominic, on that, and we've got a lot of projects in the retail space, with the Haynes having launched their own cryptocurrency, and now we start seeing some wholesale projects, which once again have the intention of securing and overcoming the limitations of the existing payments infrastructure and systems. They want to promote the financial inclusion, notably of the, once again, retail clients which are unbanked or underbanked, and also boost competition. But I don't see CBDCs being part of the FX market in the near future from my side. I think it's something that can happen in about 2 or 3 years, but I see this as a fairly remote perspective, not just now.
But if we look forward 2 or 3 years and just stick to the operational side of things, will we not have instant settlement? As move from T+2 to just doing it instantly, CBDC versus CBDC? That's history for Hurst at risk, and if it's history for Hurst at risk, that's history for maybe for CLS as well. This could be very disruptive to the existing infrastructure, could it not?
Yeah, I think you're right, but we're already seeing instant payments. I think the PIPS project makes it that if I wire money now, within 2 seconds it's on your account, and there has been already a lot of improvements from the I would say retail and small and medium corporates side. The big market, the wholesale, the real money as we call it, is not quite there yet, but it's the settlement aspect is moving quite fast. I think CLS has I wouldn't say competitors, but there are innovations, and firms like Baton Systems are doing a lot of interesting things, and I think they work quite closely as well with the HSBC actually on the instant settlement system, knowing that they allow multiple vacations where CLS tends to be just one batch a day. So there is a lot that can be done through this, and it's definitely a focus as well for the BIS, which in its latest triennial survey mentioned that the settlement risk was a key focus for the FX market and a key area for improvement.
Alan, CLS, of course, is all about the real benefit of it is in the netting. Is there a downside to CBDC versus CBDC instant settlement of cross-currency transactions? Do you lose the netting?
Well, I mean, you could do or you could not, right? I mean, I think there are a variety of different models for central bank digital currencies. I think picking on what Claude was saying earlier, the kind of central key piece for me is this idea of a shared ledger, shared golden source, which tells you effectively who's got what currency where. So effectively, that could be held all within a central bank. It could be on a distributed, decentralized basis, or it could be in a sort of multi-tier basis where effectively the central bank holds part of it and commercial banks hold the individual accounts. If we look at that kind of single tier model, which I think is kind of the base case, which a lot of the discussion around central bank digital currencies kind of starts with, then yes, absolutely. If the four of us as panelists all owed it, sort of I owed Matteo, Matteo owed Jay, Jay owed Claude, and Claude owed me $1,000 digital dollars, then we could all settle instantly. But who's going to pay first? And actually, what the multi-tier system in terms of what the kind of the central bank to commercial bank to retail customer model does today in existing digital money is provides a netting capability through the RTGS that solves those kind of problems, Dominic, exactly as you were saying. Now, those problems can be solved in similar ways with central bank digital currencies. They can be solved in different ways. And to answer your question about CLS, I'm going to give I guess, a slightly cliched answer in the sense that CLS is an incumbent here for atomic settlement of two currencies at the same time and associated netting capability. Any innovation in any market is both a threat and an opportunity to the incumbent. And I don't think you can really predict where it will go. I kind of agree with what Matthew was saying in terms of there are other people who will probably try and come along and eat CLS's lunch. But that kind of relationship with central banks and having the central bank accounts in each of the CLS currencies, there's certainly reasons why even in a central bank digital currency world, CLS could potentially still be best placed to offer that service. I think the reality is we don't know the answer at this point.
Mattia, just as a nice segue, in fact, I'm talking about peer-to-peer trading, which is a large part of what we want to discuss today. And I'm sure that Jay and Claude will want to come in on that in particular. But there's a very narrow question. Could CBDCs, by making atomic settlement possible and facilitating direct buy-side involvement, could that make peer-to-peer trading more viable, more attractive? Could CBDCs help accelerate a move towards peer-to-peer trading?
Yes, fundamentally, but I think the experts for peer-to-peer here are Claude and Jay. Frankly, I think that, once again, CBDC's objective is to facilitate cross-border payments. The whole basis of cryptocurrencies is any way to do a peer-to-peer. So, and as I mentioned, my view is that there won't be any FX CBDC. Well, FX as linked to CBDC is a perspective which is quite remote. So in the meantime, and given the fact that the institutional market is not either very involved in CBDCs for the moment, leaves a nice space to Claude and Jay's venture to offer competitive services. And we know that they also offer the execution at a benchmark at midpoint. So the interest is covered by their ventures as far as I see it for the moment. I don't see central banks and CBDCs covering that space just yet.
Okay, Jay, Claude, start with you, Jay. Take up Mathieu's challenge here to explain the case for, if you like, for peer-to-peer trading. It's easily portrayed as a form of way of disintermediating banks. People talk about it a lot as a cost saving. People talk a lot about the netting benefits before you go to market. So tell us, are banks right to see this as a disintermediating threat? And are buy-side clients in particular thinking about this in the right way if they're thinking about it as cost savings?
Yeah, I think all of that is really relevant. And so to start with the banks, I mean, we assumed when we started Hedgepool, and Claude, I'm sure you felt the same way with Siege, that, we were going to be perceived as threats, right? And that wasn't necessarily our goal, was not to disintermediate banks, but to provide the buy side with alternative liquidity, knowing that there are natural offsets in the market amongst, each other. Again, going back to what I was saying earlier, I mean, the market structure has prevented those two sides from seeing each other. So, the reason for that is because you can only trade with those who you have credit with. So I think what we're seeing, based on, the first 25 minutes of this conversation, as well as just the direction of travel with technology, is that sort of link, or that dependency between liquidity and credit is starting to break down. People are coming up with solutions, whether that's within the existing sort of framework of ISDAs and bilateral trading arrangements, or a digital ledger type of solution. I think that's going to continue to evolve. And I think at the end of the day, what banks are recognizing is that this is an opportunity to actually, monetize their balance sheet in ways that they couldn't before. A regional bank specialized in a single currency that might be, a small percentage of the overall value of the market is not seeing the rest of the market because they're just not strong in euro dollar or dollar yen or sterling. It's opening up opportunities there. And for other banks who are strong in pricing, it allows them to distribute that pricing without necessarily consuming all the possible balance sheet that they have available as a bank. So I think there's definitely a sort of a view from the sell side that's changing, and understanding that this is a structural benefit to them, not necessarily an eat your lunch story, to use some of the phrases from earlier, Alan. That's the sell side perspective. I think the buy side is kind of thinking about this perhaps a little bit incorrectly, in that it's not just a savings story. It may be a savings for some, right? Trading with peers can cut out additional layers of cost. And that is absolutely true, right? There are, based on all of these sort of legacy systems and technology, and sort of just the way things have been done, there's layers of cost built into the trade workflows that don't necessarily, that aren't required. So if you can match off your risk with somebody with a natural offset, then clearly the market risk element, the risk transfer element of that goes away. The technology for communicating is evolving, right? So it used to just be, the legacy technologies available for allocations. People are now looking at different ways to do that. And maybe digital ledger is part of that, the golden source for allocation, so that there's not all these files transferring back and forth over legacy systems. So all of these things go back to cost savings. But one of the things that has really sort of been occupying my mind a lot lately is around pre-hedging, and the global code's focus on what to do about this pre-hedging conversation, and whether or not they're the ones who should do something about it. The problem with pre-hedging, or it used to be called front running, pre-hedging is a risk management tool that banks need to do, and you can't blame them, right? If they're asked to be able to price something at 11 o'clock this morning at a benchmark rate, well, you can't just ask them not to hedge that or manage that risk. So, this is sort of a necessary problem that the sell side faces from a sort of a conduct risk perspective, right? How do I react to this trade without putting myself in a bad position while giving my client what they need? And at the other side of the equation is, and how do I do this without moving the market, right? How do I avoid market impact? So I'm sure, Claude, this is part of your daily conversations, with your product development team and with your clients. It's a matter of, look, we're avoiding market risk, and market impact altogether by naturally offsetting. And that is a really big part of the cost that's typically unmeasured. And so it sort of goes overlooked. And we hear conversations with lots of clients, and Claude, I'm sure you hear the same, that, oh, we already traded mid. Well, yeah, but how? At what cost are you really trading at mid? And what is the impact to not only your funds, but all of your peers in trading at mid by giving the banks that order in advance? So, this is, I think, the bigger part of the peer-to-peer story is how to eliminate market risk. So I don't know, Claude, I'm sure you have similar conversations around that.
No, I think
just
you
before
absolutely.
Claude, just before you end, can I ask you very quickly, Jay, to pick up on one thing you've said more than once this afternoon about how the link between credit and liquidity is breaking down. Do you mean that peer-to-peer networks are bringing additional liquidity to the market, or is it just redistributing it within the market?
I think
not a long answer, but just a
the way I look at it is that the liquidity is from the buy side, right? The buy side is the source of liquidity. Right now, it's just routing through too many channels to get to the other side of that trade, and peer-to-peer just sort of eliminates the middle from a pricing perspective and liquidity perspective.
Actually, sorry, Claude, give us your thoughts on what peer-to-peer is all about, cost saving, netting, etc. Getting our first questions.
A lot of good stuff has already been said, but maybe I suggest we just take a step back, right? And we look what's really happened in the last 5 to 10 years. And there's been a lot of constraint on banks, and capital is more expensive than it used to be. And there's probably less appetite to actually warehouse risk the way we used to. And in parallel with that, we've seen actual boom in technology, much easier access to electronic execution, the rise of the algo in the FX space, so on and so forth. So reality is, and yes, to Jay's point, more liquidity is coming from the buy side than it used to be. And these people have got large sizes to do, and they can still do risk transfer, and bank will still be there to help them to do that, and that's fantastic. But when they actually start to realize that for some of the execution, the risk is squarely back with them, of course, they have to look at how much market impact they're creating when they execute. And the thing about people said they trade at mid, well, how long for? You can trade at the next mid because, of course, the mid has moved in between, right? So that's kind of very obvious. So the whole thing is about market impact. So if you're going to wear that market impact, you need to do all you can to limit the amount of market impact that you're going to create. And if you believe that the bank will do a better job than you do a risk transfer. Or if you believe that they can help you to do this by using a bank algo, then that's what you use. So the question is not about whether peer-to-peer is there to eat bank's lunch. Bank already offer algo, so you can say that they're eating their own lunch or letting somebody else eat their own lunch. So that's not the point here. The point is everybody's looking for cheaper, more efficient ways to minimize market impact and to make the whole process cheaper. So and that is true what Jay said around what clients should look into when they're considering peer-to-peer. Yes, there's the fact that you potentially trade at mid, that's great. More importantly, you can remove your market impact or reduce it as much as you can. And equally, you should look into, are you going to be reducing your overall cost of processing a ticket? So an example of that today is internal netting. So clients trade against their own fund through a bank. And then they push that bank to book absolutely everything, use a huge amount of balance sheet. Why? What is the relation between the amount of tickets that's been booked compared to the amount of risk transfer? There's no comparison between the two. So you're forcing a bank to use a huge amount of balance sheet for very, very small amount of risk transfer. Is that attractive to a bank? Of course it's not. So why don't you find everything that's available to you to reduce these costs? Peer-to-peer is the perfect example of that. So it's not creating new liquidity. It's helping to make liquidity work for you. So if you're deciding to sit on an order today because it's large, you don't want to go to market, what happens to the rest of your order in the meantime? It does absolutely nothing. It's not being worked. But if you are in a position to place it in a market neutral peer-to-peer environment and limiting the information that's going to go away from you, then clearly you can start to actually monetize the time that you're going to wait to execute your order. And I think that is what's so attractive about peer-to-peer today. And the reality is it's already worked in other asset classes. One of the reasons why it's taken so long in foreign exchange is going back to the same point. Everything was always coupled between liquidity provision and credit. And as technology is now helping us to decouple these two items, there'll be more and more peer-to-peer activity going through. That's just a natural evolution. And it's not against bank. As a matter of fact, we're partnering with banks. Both Jay and I are spending as much of our time building things with bank and offering new services. And banks are very willing partners because they also see that this has value to them.
Thanks, Gordon. Now, we've had a question from Jamie Wilson, which is relevant to this, because if you are trying to measure your impact, you've got to measure it somehow. And there are, you yourself, Claude, are operating with the new change FX mid-rate benchmark. Jamie Walton's question, and I can see where this question comes from, where it's going in a way, is this: is there an opportunity for alternative benchmarks to improve the execution, in particular with regard to pre-hedging and market impact? Now, you're not allowed to answer that, Claude, because I know what your answer is, but perhaps, Alan, maybe you could give us a semi-independent view of that answer to that question.
Yeah, look, I mean, I think it comes back to what Jay was talking about a few moments ago, and look, I think we've got to draw a distinction between pre-hedging and historical misconduct, whether we want to call it front running or anything else. I don't think anyone involved in this webinar is making any suggestion that right now banks are doing anything other than appropriately managing risk that's passed to them. And I think both Claude and Jay made the very good point in terms of you've got a choice. And when we talk about why has peer-to-peer been slow to take off in FX, I think we also have to acknowledge, and I think we all have done, but to emphasize again, banks have done a good job. I mean, there was the new change were involved in that research piece, and that quoted a number, and I don't recognize that number necessarily, but it's in the public domain of what, $267 per million. That's less than a quarter of 1% to transfer from one asset to another asset. And we can all talk about it as having worked in this market as there are potentially more efficient ways of doing it. But compared to transferring one asset to any other asset in any other in any other realm, it's really not very much at all. To come back sort of off that to Jamie's question, that I think the guys are absolutely right that you've got to look at the total cost of execution, and so that is the all-in price, including all of the execution costs that you've paid against what would have been the price if your transaction hadn't gone through. And so you've absolutely got to think about the market impact of that, and potentially the market impact of hedging activity. And I think we all know on the panel, and many of the participants today will know, that Jamie's involved in an initiative to try and capture that in terms of generating a benchmark. Dominic, you alluded to that as you introduced the question. And look, I think there's some interesting research that Jamie and his team have done. I think that the reality is where you have a dispersed OTC market, with innovation like the platforms that Jay and Claude have produced, it is very difficult to say authoritatively what a mid-price would have been and what wouldn't have been. And choice around how you analyze it and different benchmarks and different ways of measuring it have got to be welcome, in my view.
Mm-hmm.
I think if I could just jump in there too, I think it depends very much as well on the objective of the trade too, right? A lot of the WM-based executions are executed WM not because they like WM per se. It may just be that that's what their benchmark is, right? They're index trackers with performance measurements around that benchmark. So whether that's a good price or a bad price is kind of irrelevant to their performance, because their job is to track it with precision. So, that is one thing that I think is, until that benchmark is sort of replaced with something else, then they'll start tracking a different benchmark, but that will probably remain for a long time. But I think that there's also a very large set of other types of trades that are more alpha generating trades, or, trades where, that are linked to a transaction, an underlying transaction or security, where, alternative benchmarks, I think, have a lot of room to grow.
So, Jay, we can end up down a rabbit hole here that I'm sure Dominic doesn't want us to go. But I think we've got to consider the asset owner in here, and I much as I agree with you in terms of index tracking being done at WMR, but to say that if it's WMR, that's great, kind of ignores the impact on the asset owner of an index translating from one currency to another currency at a price that may have reflected the FX market at 4 p.m. on a particular day, but at no other point, based on supply and demand imbalances targeting that particular price. So I think there is that broader question.
100%. Yeah, no, I'm not debating, and I think that's a much bigger discussion now around whether or not that's the right benchmark. But the fact is, it is, and index trackers by name are tracking the index. So until their mandates change, that will remain as their as their benchmark.
Is it the right benchmark is a good question. Alan brought up there the new change Lumin study, which looked at asset managers hedging their portfolio risk and the share class currency risk in funds they manage, and came up with this number of $267 per million. Now, that doesn't sound like much, as you pointed out, Alan, but collectively across the industry, the same report says that's $5 billion a year. And that's $5 billion, which the buy side are not collecting as a result of these transaction costs. Now, I seem to have been hearing about, measuring impact and transaction cost analysis in FX for at least 30 years now. And now we have a proliferation of benchmarks. The point you just raised a minute ago, Jay, is that the right benchmark? There are a lot of benchmarks out there. So I'm wondering have we actually made any progress here? Maybe Jamie Walton can chip in here, because I think he's asking a very valid question. That if we are trying to measure our impact and our costs, do we yet have the right tools to do it? And if we don't, why not? Is it because we're not collecting the right data, or because we don't have the right methodologies, or because it's technically impossible to collect the data quickly enough and present it back to take decisions? What's really going on in benchmarking FX performance? Who wants to? Claude, perhaps you have some.
Yeah, well, I think we'll go back to the earlier question about what we could add up from other markets and what's going to make FX more efficient. Well, all the other arrangements are far more transparent in terms of data points, timestamps, the way data is collected and can be shared across participants, and that's the key element here. Yes, there's still a lot of educations to be done, and not everybody sees it the right way around, and not everybody thinks about it as you say. It's easy to say, well, let it small compared to equity, so I won't bother about it. But actually, it is still a big number. But you're right. We did a study back in 2019, and the hardest thing for clients who participated in our study was actually to clean the data. They struggled around providing the right timestamps for their own execution. So I think because we're dealing with legacy systems, and it's quite hard to track all of these things. From the time the ticket actually leaves your OMS, goes to your EMS, goes to the bank, then gets traded, then gets booked, then goes back to you, which timestamps are you looking at, right? So it's extremely hard. So data here is at the core of the problem. The access to that data, quality data, and there's no consolidated type for foreign exchange. It's not like there's a centralized source that everybody can tap into and say, oh, these were my timestamps. So yes, the more work is needed there. And that's one of the things that we should adapt from, and accept from other new emerging technologies, is this ability to be far better at managing data around the trading and the post-operation process.
Mm-hmm. Yeah, if I can just add something there too. I think one of the things that I've always struggled with in foreign exchange is that there's always been this hyper focus on point in time transactions cost analytics, when in other asset classes, there's this idea of implementation shortfall, where it starts with the origin of the trade. And then there's all of these workflows that, need to take place before a trade is even available for execution. Then there's the decision-making to execute it. So, and there's all of these different elements of performance that I think are ignored in FX largely, because it's really, it's a point in time measurement in many cases. And I think there are, emerging technologies. There's TCA providers who are trying to go further upstream into that measurement. But I still think FX is quite a bit behind other asset classes.
Jay, I'm going to take a little bit of an issue with ignored. Not that I disagree with you that it's not taken into account. I think I think people are aware. It's just difficult.
Yeah,
it's because we're dealing with legacy technology stacks that make it difficult to pull the data, and a dispersed market structure that makes it hard to have this definitive view. I mean, Claude, I would be nervous of the idea of it in any way it's suggesting that a more sort of regulated, less dispersed market structure would give a better outcome to clients. Because personally, I don't think it would, and I don't think an exchange traded FX market actually gives better outcomes for clients against the innovation that's new technology practices and offerings like yourselves.
Oh, yeah, you're right. It's about technology as opposed to overly regulating the whole thing. Regulation doesn't mean you're going to go faster, more cheaply, or being more efficient. Yeah. But if you have better technology, you hope that you should.
Well, I'm going to pick up the legacy point you made in a minute, Alan. But Jamie Walton has actually has joined the discussion and given us some observations which I think are worth
Well, I was just going to say, Dominic, sorry to interrupt, but I felt that one of the issues is that you were talking about plethora of benchmarks, but I don't think that's right. There is one benchmark at the moment, and that's WMR. And it's the only reference that is being used in index tracking or whatever. And therefore, if it's the only benchmark, it's the only one that, and the one that everybody is trying to play with. And we all know that just look at what's happening every day at 4 p.m. We've got the high frequency traders stepping in and pushing the trend, distorting the rate basically. So an alternative benchmark definitely would be welcome because it needs an evolution in the mindset of people like MSCI or JPM Index or whatever, because they would need to offer the alternative of benchmarking the execution against an alternative benchmark. But today, there is only one benchmark which is widely used. It's a monopoly. So this needs to change in my view. And I think to answer Jamie's question, yes, there is room for alternatives. There used to be the ECB benchmark, the ECB fixing, which was removed, I think, 6 or 7 years ago, or not removed, but it's still there, but it's published much later after it's been calculated, so it cannot be used as a benchmark. Only WM today exists, and there is definitely room and a need for alternatives.
The buy side is at fault here for not choosing more apposite benchmarks.
Yeah, so look, I think we just need to separate what we mean by benchmarks here, because I agree with Mathieu in a sort of subset of what I would think of the benchmark definition as a reference price within other products, be it indices, be it derivatives products. Absolutely. It is WMR. I think there are, however, other benchmarks, and I'm sure Claude will talk a little bit about new change and what he's doing there, and a variety of other benchmarks that TCA providers will use as reference prices when looking at transaction cost analysis. But there's almost two divergent conversations here. One around benchmarks for reference pricing. Mathieu, I completely agree with everything you've just said there. And then a second conversation around transaction cost analysis, looking to provide transparency in the market and some of the work that Claude and his team are doing.
Yeah, no, you're absolutely right. I think we should not confuse the two. And but going back, you see we should separate benchmark. We should also separate buy side. The real push here needs to come from the asset owners. I think you alluded to that earlier, Dominic. It's them at the end of the day that need to push for that. And if you're an index tracker, then of course you're going to track the index. But if you're using this to perform your share class hedging, then it actually impacts your performances. Mm-hmm. That is real money, real pensioners' money that disappears. Yeah. So that requires a different type of response. Yeah. And then, of course, there's a different category to that benchmark, which is the measurement. If you're measuring market impact, you need to have a proper instrument to do so, which is what we're trying to do with the new change rate. But again, that's for a different purpose. It's for measurement. It's for creating a neutral point of reference. If you're looking to execute onto something, yes, there's a need for an alternative. But there's a real question for the buy side, but the asset owners, as to why they're not pushing for it in the first place.
I think it's interesting, just listen to what a couple of comments you guys said. That the distinction I'm starting to think about in my head is the difference between a reference rate and a benchmark. Right? A reference rate to me is kind of, all right, that's implicit in your mandate. It's an index, it's defined by the index. That is your reference. That's what you're going to be measured against. Benchmark can be any number of things, right? It's how you benchmark your performance given the nature of the trade you were doing. Given the site where you are in the cycle of that trade, there could be many benchmarks along that timeline of, the 3 hours it took you to generate the order and execute the order. There may be 6 benchmarks along the way. So I think that that's a distinction that we should start thinking about because that's where I think in benchmarking, there's a lot of room for new entrants, and the WM is probably not the right, rate to use for pure benchmarking and performance.
No, you're absolutely right, Jay. That's why, the rate we're using is actually live and continuous. And if you're right to perform any sort of measurement over an execution period, you need to have that. The one point in time in the future serves absolutely no purpose for that case. You're absolutely right.
Yeah.
Okay.
I would say that FXTCA also is, sorry, go ahead, Dominic.
Well, I was just so we have about 10 minutes left, and I'd like to turn to ops and technology. But before I do, two things. One is Jamie Walton has said to us, I think TCA, transaction cost analysis, does need to step up to capture these effects. And I assume he was talking there about market impact, among other things. And he also adds there's no agreed way yet to measure market impact. So I think that ties up our benchmarks conversation quite neatly. Unless, Mathieu, you wanted to add just one thing very quickly to that.
Yeah, I was just going to add something, which is FXTCA, in the case of institutional investors, it's quite difficult one, and that's been alluded to just before, because the FX is a consequence of their initial investment generally. So, the FX exposure is created once a European asset manager has bought American stocks. So the FX exposure is here. But between the time he does his transaction on the US market, the time this transaction is processed by the system and generates the underlying effects or the consequential effects, there can be an hour, there can be a day. So it's extremely difficult to associate FXTCA for the investment space, and there would be a need there is room for improvement there as well, defining when is the right moment to do your timestamp, and that's been discussed before. Because will it start when the FX starts being done, when it's completed? It's sort of quite a difficult one to measure.
I can see it's very, very difficult to, as a buy side user of the market, you want to understand what it's costing me to do this thing, and actually arriving at that cost is very, very difficult.
Correct.
For a whole variety of factors. But there is one cost which we could do something about right now, and that's the post-trade costs. We've got this extremely fragmented post-trade infrastructure at the moment, matching and confirmation, credit, netting, novation, the allocation reporting, the cash settlement, all done by sometimes more than one organization. And Alan mentioned the issue of legacy systems, lack of budgets to repair them, and so on. But I feel one area which FinTech in particular, or new technology, can make a real difference. And the recent alliance we saw between Cobalt and Baton suggests something can be done here. Why isn't it actually happening? After all, these banks, even very large banks, are racking up costs they don't need to incur post-trade. Yet they seem to find it very, very difficult to do anything to reduce those costs. What explains that? What's the hold-up here? The technology exists. The answers are fairly obvious. The solutions are out there, provided by more than one fintech. Why isn't anything changing?
Because it's much, much easier to build a plane on the ground than it is to rebuild a plane whilst it's in the air. And I know that it's a cheap cliche, but I really think it rings true in this case.
Yeah, that's also true, but I think that the other thing to consider too is that what incentive does the buy side have to change when they've got systems that work that they don't pay for, and that the sell side is obviously, and I'm not suggesting that they should pay for it. I just
sorry, but they do pay for it ultimately, don't they? Because
they do, but it's one of the implicit sort of unmeasured costs that are, I don't want to use the word ignored again out of fear of Alan. but I think it's one of those, out of sight, out of mind. It's free, so, and there's a cost of technology to rebuild systems that are working.
Well, that could be said of FX as a whole. If whatever you pay for FX is in the price, it doesn't show up as an invoice at the end of the month, you could say, "Oh, trade FX are free." Well, guess what?
That's I think in large part,
banks would be out of business, and none of us would be talking about it.
But that's probably
I think Alan is right. The amount of risk that these people are not interested to take in order to change the system quickly is so high. That's why it's so slow. And you mentioned the right names, Dom, Cobalt, and I think these guys are great. But you look at what the market is looking to achieve and the amount of risk that's behind this. Nobody's incentivized to take that risk today. So what's going to take us to that point is going to have to be properly measured and identified and demonstrated to people before they can say, actually, now I do know I have that cost. I need to do something about it. And there's a real incentive for me to attack that risk. That risk, that push needs to come from, on the one end, what we discussed earlier, it needs to come from the asset owners. It needs to come from the regulators. It needs to come from all these people. We always talk about best execution, and never gave a definition of it. But the reality is, when you look at best execution, you should just not look at the spread you pay, or not even just your market impact. You should actually look at how much it's going to cost you to process the ticket from start to finish. We've done some work recently which showed that the cost of balancing the tickets between the messaging system and whether it's whichever system, back office system you can think of, and then sending the messaging, reconciliating the trade, pinging for the SSI, so on and so forth, and actually make the cost of that ticket a multiple of whatever spread you can save on the execution. That's not taken into consideration today because it's not the same cost center. But that needs to be part of the overall process. People need to look at this far more carefully, identify things better, more measurement, better analysis, and actually take a real decision. Is this worth me going for trying to optimize just risk transfer, while at the back end, I'm actually paying multiple times what the savings are going to be on the risk transfer? It needs to be a far more holistic project, and there needs to be clear incentive for people to do that. So the push needs to come from both ends of that story. The asset owners, those with those assets, the people in between, because that's also impacting their costs and their performances as well as an asset manager, as well as of course, the banks are probably a little bit quicker at that because it's impacted their balance sheet directly, and they've been under scrutiny for that. But the regulator needs to make sure that this is understood and applied across the industry, not just the banks.
I'd add too. I mean, I think, Claude, you mentioned the, risk, right? That is a key thing here, right? And so we're balancing risk, which, people don't want to make change and introduce risks if something's working okay, even if it's a little bit more expensive. So I think it's about incremental change. Yes. And I think the word disruption is always used when it comes to fintech. And, we talk about this all the time that, we're trying not to be disruptive, right? The key is to be, sort of invisible. Like, it needs to be automated. It needs to be part of a familiar workflow so that it can create efficiencies without substituting, in risk and other costs. So, it's always about non-disruptive technology, incremental change that ultimately I think is going to get there. If we try and eat the elephant, I think we're just going to, it's just never going to go anywhere.
It's about fitting in with an existing workflow to improve and optimize it as opposed to trying to break it.
Exactly.
Nobody's got patience.
And I think you just need to look at the amount of FX which is still processed by the custodians. And I don't want to go back to what happened 12 or 13 years ago. But the comfort that the custodian process can bring to those asset managers, asset owners, because FX is definitely not their core business. The savings they make on operational risk, on credit risk as well, because they will be benefit from interesting credit arrangements from their custodian, the liability cover as well if there is a problem. All of those factors are comforting for asset managers and asset owners to maintain the FX with their custodian eventually, even if it comes with a premium. So it's not all about cost, it's also about risk, as Jay and Claude was just saying.
Yep.
Okay, we're into our last couple of minutes, so we must stop, I'm afraid, in a minute, although I can see we could go on for a very long time indeed. And I'm getting a bit depressed, actually, because I began this discussion thinking that actually I'd totally underestimated the volume of change which is going on in the FX industry. I'm now hearing from you that, in fact, plenty of very large banks involved in the FX industry fully understand that their post-trade costs are excessive, but they're not prepared to do anything about it because the risk of doing something about it far outweighs the cost.
And that's what I wanted to come back in on, Dominic. And because actually the impression I get is that the big institutions, and it's not just banks, sell-side institutions, it's asset managers, it's execution platforms and so on, are very, very aware of this, in the sense that they very much understand that there are these constant sort of news articles, pieces in terms of cost of technology going down, cloud-based, services-based, and so on, but they don't see their own technology builds going down. So I think two things. I think there's an understanding that it is more difficult because it is harder to rebuild the plane whilst it's flying along, but also over the next period of time, and we could be talking as long as a decade or two, but over the next period of time, it has to change. And I think we're all having conversations in different ways with market participants of all shapes and sizes in different parts of the market, where this is going to change. The legacy cannot persist because if it does, then particular service providers of all sort of shapes and sizes in the market are over a period of time going to price themselves out of continuing to do the business that they do. So, Dominic, personally, I'm an optimist, but I just think it's going to take a period of time to get there because of the risk points that Mattia just mentioned.
Okay, now it's now 3 o'clock, but we're running over time. We started a little bit late, so let's just carry on. I'd like to ask each of you one last question then in response to what you've been saying, Alan. Claude brought up the question of the regulator, the regulatory role. You know, we've had this FX Global Code, which has been in place for some years now. The buy side won't sign up to it. If I remember, it had like 55 or 57 different ways in the back of it, in which banks can rip off buy side clients. And here we are still talking about how comforting the buy side finds the working with the banks and how the banks are not prepared to make revolution in their back office costs and thereby cut the charges they pay to the buy side. So if you were the regulator and you were looking to make this market less asymmetric for the buy side in particular, let's say if you could be the god of the FX market for a day, what would you actually do? What's the one measure that you would take? Mattia, what would be the one thing you would like to see the regulator actually do?
Well, I won't thank you for asking me first on that because I'm not God because I will die one day. No, frankly, I think the FX code is a good thing. I would really hope if I were the FX god that the buy side would sign up to it because they are instrumental. I mean, I think Jay, you said that they were bringing the liquidity to the market. You're right. International investments have exploded over the years, so they are the ones driving the markets generally. They are the ones bringing the big flows at the 4 p.m. They are the ones bringing the big flows at the month end. They should really be aware of their impact on the market, and they should be wider adherence to the FX code. That's if I was the FX code, I would ask them to sign up to it more. I think there's been good progress. I think amongst the top 20, 10 or 11 firms have signed to the code, but it needs to be more widespread. I think it's good enough as it is for such a large market. Adding more regulations would probably make it less efficient.
Right. Claude, what if you were god of the FX market for a day, what would you ordain?
Well, that's a tough one, but I think, I think Alan said that earlier, each problem brings an opportunity or each challenge brings its own opportunity. I think we did identify a very key challenge here, which is the ability to measure and produce good data. I'd probably look to impose, to an extent, some sort of quantities of items that need to be measured. And I do understand that people find that hard and it would probably be painful to implement, but there's plenty of providers out there that could help people to come up with that data. And that data in turn would actually highlight certain things that they have to do. There will be no more excuses if you want to not do certain things, because then you're confronted with the real hard evidence that's in front of you. So probably try and impose more measurement as a minimum rule.
I like that idea. More and better data, greater transparency, if you like. Jay, what's your god of the FX market?
Yeah, I think, both the answers before me were actually quite good, and I think are probably the two things that are probably most important. But I think the top thing would be getting buy side more engaged and more involved, because at the end of the day, it's really, the buy side is who is responsible for the performance of our assets as the ultimate asset owners, right? This is my retirement account, your retirement account. They are the ones that are looking after it. So we want to make sure that they're not just passing on the risk to the banks to deal with it. And so they should be aware. And I think that comes from data, but I think being involved and having more active engagement with the code.
Mm-hmm. Thanks, Jay. So get the buy side more involved. Alan, you have the very last word of the entire webinar, which is an unfair position to put you in, but please have a go. What if you were god of the FX market? What would you actually do?
So I think there are a couple of things. I think, first of all, reflect that FX is the foundation of the global economy, picking up on what Jay was just saying. And Dominic, I slightly disagree with you with where the premise is, because I don't think the premise is that bad. A lot of progress has been made. We talk about conduct in the FX Global Code. And a fraction of 1%, a small fraction of 1% in terms of translating from one currency to another, and that being so dispersed to wherever it's needed in the global economy is not that bad. But I still agree with what everyone is saying. It can be done better. And I just pick up on what the other three panelists and say, it's about disclosure and transparency. If I was God of the FX market for a day, I'd be pressing on each participant in the market to, you've got to explain more about where your costs are coming from, how you operate to your stakeholders, be that sell side to buy side, be that asset managers to asset owners. We've got to increase understanding and buy-in, and that comes from data, links to the global code, and sort of picks up in terms of buy-side engagement as well, in terms of what Jay was saying.
Thank you, Alan. I'm afraid we must stop there. We're out of time now, but it's been a fascinating discussion. I'd like to thank our panelists, Claude Goulet from Siege, Anna Gill from Hilltop, Mathieu Herbeau, and Jay Moore from FX Hedgepool. And thank you also to you, our audience, for listening, and to Jamie Walton in particular for that very interesting and seminal question which he put. Here at Future for Finance, our next event is a couple of weeks today, June the 8th, where we're going to be talking about digital assets, the post-trade aspects, as it happens, of digital assets. And I hope that if that's in your ballpark, that you'll be able to join us then at our usual time of 2 o'clock London time, 2 weeks today. That's June the 8th. But for now, it's goodbye from the five of us.
Thank you.
Thank you for joining us. You can find this discussion on www.futureoffinance.biz and indeed other planned webinars under current events. I am Wendy Gallagher. If you would like more information about how to work with us, please do email on wendy.gallagher@futureoffinance.biz. Thank you once again.